But Trump tax still, temporary relief, lasting debt challenges. Summary: rising Treasury yields show fiscal unease, tax cuts estimated to slash 4.5 trillion in revenues over 10 years, expected rise in corporate profits and stock values. By passing President Donald Trump's comprehensive tax cut and spending plan, the U.S. government recently dodged an immediate risk of defaulting on its debt, but at a potential price for its long-term financial health. The legislation, approved by the House, extends the tax cuts from 2017, allocates additional funds for border security and the military, imposes significant reductions on Medicare and Medicaid, and unfortunately, adds trillions to the federal debt. President Trump is expected to finalize the legislation with his signature. But here's where it gets controversial. The tax package includes a $5 trillion increase to the government's borrowing limit, allowing you to avert the X date, the moment when the Treasury might face a default if it cannot meet all its financial obligations. Originally predicted to occur between late August and early September, this measure puts a pause on this pressing issue. However, the long-term outlook is not entirely positive. Analysts are raising concerns about the tax bill's impact on the U.S. bond market and the country's financial stability. The debt is forecast to balloon by an additional $3.4 trillion over the next decade, increasing the risk of higher bond supply and diminished demand for U.S. treasuries, an issue that is crucial for global financial markets. But this is the part most people miss. There's a real possibility that demand for the $500 billion in bonds the U.S. issues weekly could fall, pushing borrowing costs upward. In a recent statement, BlackRock highlighted the pressing need for more aggressive fiscal adjustments to maintain the U.S.'s revered position in the global financial system. Boldly, the tax bill is predicted to shrink tax revenues by $4.5 trillion and reduce government spending by $1.2 trillion. Potentially resulting in 10.9 million individuals losing their federal health insurance over the next decade, according to the Congressional Budget Office. On the flip side, the bill promotes economic growth by enabling businesses to deduct the full cost of equipment and research investments, along with other tax incentives. Still, some investors have reservations about the enduring effects of the debt, which might limit the economic boost the one big beautiful bill aims to deliver. And here's a hot-provoking query. Could this stimulus inadvertently lead to prolonged higher Treasury rates, making bonds and other fixed income options less appealing in the long run? The bond market reacted somewhat mildly to the bill's approval, mainly because it had already priced in an expansion of deficits. What do you think about the balance between immediate fiscal relief and long-term financial stability? Share your thoughts and join the conversation in the comments below.